Most Australians never actively pick their super investment option. They just inherit whatever default their fund handed them. But the label on that option, whether it says conservative, balanced or high growth, is one of the biggest levers on how much money you retire with. Today we settle which one deserves your money. This is not a trivial choice. Colonial First State modelled a member investing in super for 30 years and found that choosing a high growth option at 7.0% per year instead of a balanced option at 6.2% could deliver over $80,000 more by age 60 on the same contributions. Add $10,000 a year in extra contributions and that gap stretches to over $120,000 according to the same CFS modelling. The Productivity Commission went further, showing a top quartile fund could leave a worker with $1.1 million versus $610,000 in a bottom quartile fund, a $502,000 or 45% shortfall. Here is the at-a-glance picture. SuperGuide classifies high growth as 81 to 95% growth assets, balanced as 41 to 60%, and conservative as just 21 to 40%. The trade-off is simple to state and hard to live with. High growth swings harder year to year, but compounds to more over decades, while conservative options buy you stability at the cost of long-term gains. High growth options put the bulk of your money, typically over 80%, into growth assets like Australian and international shares, property and infrastructure. ASIC Money Smart explains these options target stronger long-term returns, but with more ups and downs, which is exactly why they suit people with many years to retirement. If you're in your 20s, 30s or 40s, you have time to ride out the dips and capture the higher long-run return that history rewards. The strongest case for high growth is mathematics. Colonial First State's modelling found that a 0.8 percentage point return edge, 7.0% versus 6.2%, compounded into over $80,000 extra at age 60. With an additional $10,000 a year in contributions, CFS shows the gap exceeding $120,000. Even a member switching at age 50 with only 10 years left could end up between $22,336 and $26,784 ahead, according to CFS. So the advantage is not only for the young. High growth is not free. Industry guidance notes that with substantial exposure to growth assets, investors should expect a negative return roughly once every 5 years. That volatility is the genuine price of higher long-term growth, and it only becomes a problem if you sell in a panic during a downturn or if you're within a few years of needing the money. For someone close to retirement, a bad year just before you stop working can be hard to recover from. Balanced options hold a blend of growth and defensive assets, while conservative options lean heavily on bonds and cash. ASIC Money Smart describes balance as targeting steadier but lower returns, and conservative as offering more stability but smaller gains. These options genuinely suit people approaching retirement who want to protect what they have already built, because a smoother ride matters more when you no longer have decades to recover from a market crash. The real strength of balanced and conservative options shows up at the end of the journey, not the start. ASIC Money Smart says that as you approach retirement, balanced or conservative options can help protect what you have built. A market fall in your final working years is far more damaging than one in your 30s because you have no time to recover. So dialing down risk near retirement is genuinely sensible. The lower volatility also helps disengaged members avoid panic selling. Here is the real catch. There is no standard definition for conservative, balanced or high growth across funds. SuperGuide notes Host Plus Balanced allocates about 76% to growth assets, while Vanguard Super Balanced allocates only 50%, even though both use the word balanced. That means the label tells you almost nothing. Worse, staying in a genuinely conservative mix for 30 years could cost a typical contributor well over $120,000 compared with high growth, based on the CFS return gap. You must check the actual growth asset percentage, not the name. Let's score the rounds directly. On growth asset allocation, high growth carries 81 to 95% per SuperGuide versus 21 to 60 for balanced and conservative. On return, CFS models high growth at 7.0% against 6.2% for balanced, and that gap compounds to between $80,000 and $120,000 over 30 years. High growth wins those rounds clearly, but on volatility, balanced and conservative take the point with fewer and gentler negative years. 3 more criteria. For members under 50, Money Smart's guidance favours growth options, so high growth wins suitability for the young. For those near retirement, balanced and conservative protect capital, so they take that round. And on label clarity, high growth tends to do what it says, whereas balanced hides a huge spread from 41% up to 76% growth assets across funds per super guide. So high growth edges it. Tallying it up, high growth takes 5 of the 7 rounds, winning on allocation, returns, the 30-year outcome gap, suitability for younger members, and label clarity. Balanced and conservative win 2 rounds, both tied to lower volatility and protecting people who are close to retirement. The pattern is clear. High growth dominates when time is on your side. If you remember one thing, make it this. The single number that decides which option wins is your years to retirement. ASIC. Money Smart says that with many years left, a growth option might suit you because you can ride out volatility, while balanced or conservative options become appropriate as you approach retirement. Time, not the label, is the deciding factor. So here is the verdict, and it genuinely depends, but the rule is clear. If you have 15 or more years until retirement, high growth almost always wins. ASIC Money Smart says you can ride out the volatility and capture stronger long-term returns, and CFS shows that Edge is worth $80,000 to over $120,000 across 30 years. If you are within 5 to 10 years of retirement, shift toward balance to protect what you have built, because a crash just before you finish working can be hard to recover from. Conservative only makes sense very close to or in retirement. And whatever you pick, never trust the word on the label. Superguide shows a balanced option can hold anywhere from 41 to 76% growth assets. So check your product disclosure statement and confirm the actual percentage matches the risk you actually want. Let's make it actionable. Choose high growth if you have 15 or more years to retirement, and you can stay calm through a roughly 1 in 5 negative year, because that is where compounding rewards you most. Choose balanced if you're within 5 to 10 years of retiring and want a smoother ride. Choose conservative only when you're at or very near retirement and protecting capital matters more than growth. And in every case, open your fund's product disclosure statement and confirm the actual growth asset percentage, because the label alone, as Superguide proves, can be wildly misleading. Before you log in and switch options, pull up your PDS and check the real growth asset percentage, because the right choice could be worth 6 figures by retirement. If this helped you see past the label, subscribe to The Fine Print for more evidence-led money breakdowns that put the numbers first.